Good afternoon, everyone. Good afternoon. This is Charlie Tian again. Very glad to see you. And Happy New Year. It's the first week of the new year. And Happy New Year. Let me know where you are and say Happy New Year to me. And I'll be very glad to hear from you. And it's exciting, actually. And we had a great year in the stock market last year. In 2021, the SP 500 was up more than 27%. And that was after a very good year in 2020 also. Where we are now and what can we expect this year? That's what I'm thinking, and I would like to share some of the thoughts with you today. Of course, I will also mention some features we are developing and answer your questions about the website also. And this is a PowerPoint I prepared. I will share with you here. Okay, and so I mentioned that in 2022, the stock market return was great. What was a market driver, and why the market went up so much? I think one reason is that the extremely low monetary policy. We all know that the interest was extremely low, and also Fed was buying back marketable securities every month. And also another reason was that the earning recovery from the pandemic. So in 2021, we had a great run with the market, but now today, the market valuations is close to all-time high, actually have been making new highs all the time. And where are we now? Today's market is quite different from last year, I think. And we have the valuation at an all-time high, and the Fed is tightening the monetary policy. That's making the market jittering, I think, these days, and NASDAQ went down quite a bit yesterday and today. And I see lots of high growth stocks have coming down quite a lot actually during the last few days. So where are we? And there are also other challenges. The earning growth will be slowing down, and China is slowing down also. The interest rate will be higher. But there are good side also. The pandemic will fade. I think the pandemic will mostly finish this year, although I thought about that last year, but we know that Omicron is not that bad, actually, although lots of people get infected. Even lots of people I know got infected, but I think the pandemic will slowly go away. And after the pandemic goes away, the consumer will come back to the economy, spending more, I think, and more travels, more tourism, a lot more economic activities. That's what I think. And also, especially, although Fed is tightening the interest rate, tightening the monetary policy, but the Fed is still a very accommodating Federal Reserve. And if you think of that, their role is to help the employment and also control inflation. And they are tightening the monetary policy. Seems like the market thinks that inflation will not be too bad, as 10-year interest rate is still low, and also it went up a little bit these days. And where are we with the valuations? This is a Buffett indicator. I'm not sure if you are familiar with. If you want to know more, you can always let me share the webpage where you can find the market valuations. So if you come to GuruFocus, we have the market manual. The first one here is Buffett indicator, which tells you where we are with the stock market. And it's actually calculated Warren Buffett originally calculated with the total market cap divided by GDP, but because the Federal Reserve balance sheet is much bigger these days, we are using the total market cap divided by GDP plus the total asset of the Federal Reserve these days. So we modified the indicator, and still it's a very high valuation. If you look at here, the green line here was the original calculation by Warren Buffett. It'd be above 200% today. And with the modification, it's slightly above 150%. And it's still higher than any time in history. Actually, we start track this in 1970s. So the valuation is extremely high. And also another measurement of the market valuation is Shiller PE. It was invented by Professor Shiller, a Yale University professor, and which measures the cycle-adjusted price to earnings ratio. Currently, we're at about 40 with a Shiller PE, and historically in year 2000, it was higher. It was about 10% higher than it is today. But other than the dot-com bubble in year 2000, Shiller PE was never this high. So we have a very high market valuation. So I come back to here, and I talked about Shiller PE also. The 20-year average was about 25.8 for Shiller PE, but today we are at around 40. Of course, the interest rate is much lower than it was 20 years ago. And as value investor, we like to call us value investors. Although I don't distinguish value and growth that much, that clearly, I don't distinguish them actually. But there's a trend we all know in investment style. There are value styles, there are a growth style, and this chart, the upper chart here, shows you the relative performance of value stocks and growth stocks for the last 40 years. You can see that when this line is above the black line here, when this line above the black line here, value outperforms. When this line is under the black line, growth outperforms. So we can see that in 1980s until about 1990, value outperformed here, this area. But then the growth started to outperform starting 1990. And although value came back a little bit in 1995, around 1996, but then during the dot-com bubble, the growth outperformed dramatically during the dot-com bubble here. And then after the dot-com bubble burst, the growth started to underperform. Value investing started to become popular, and value outperforms here. You can see it here, value outperforms a lot during the early 2000s until the housing bubble crash and growth. The interest rate became really low. Here is a 10-year Shiller rate. The interest rate became really low, and the growth stocks start to outperform here. And the growth stock have been doing really well afterwards. After 2017, it was doing even better. And last year, actually, about this time last year, value came back some. I thought value would come back, actually, but actually, no. Growth continued to outperform last year by large margins, by very wide margins. And we're now seeing the outperformance growth stocks as never before. We are seeing the highest outperform of growth stocks, actually last 2 years. And this is the interest rate. So what is causing that? If I go closer to the chart, I zoom into the last 3 years. I zoom into the last 3 years of the chart. And this interest rate, we can see that due to pandemic, Fed lowered the interest rate dramatically, and even the long-term rate becomes so low to 0.5%. And so the growth outperformed. Growth stock did really well in year 2000. We all know that Cassie Wood's ARK ETF did extremely well in year 2000. Why? Because the interest rate was so low. The 10-year rate was less than 1%. And with a low interest rate, if you think of the discount cash flow model, and with a lower interest rate, the value of money, of growth is more valuable. The growth is more valuable. That's why in year 2000, even lots of companies, as long as they have high growth, although they don't have earnings, the stock went up a lot, like Zoom, QuantumScape, an electrical car company, and they went up dramatically. But then in year 2000, the interest rate went up. And interest rate went up. As interest rate went up, the value of growth is worth less. So that's why Cassie Wood's ETF ARK crashed during year 2021, actually. And this year, we know the last few days, the NASDAQ hasn't been doing well. And I think one reason is because the interest rate is going up. So if interest rate goes up, coupled with the current valuation, I think probably value will do better, and growth will not worth as much, and value will probably do better. That's what I'm thinking about the market. And I mentioned about actually the different investing styles, value, growth here. I want to review it. We know that there are value styles, there are growth styles. If you look at this one, there are investing styles that focus on valuation, like this here, focus on valuation. There are investing styles focus on growth. And there are also investing styles which is in between. A GARP. GARP means growth at a reasonable price. So we still, for GARP people, they still like growth, but they want to have the growth at a reasonable price. And if we think of the investors, Ben Graham was focused mostly on valuation. He and his students like Walter Schloss and Pranvas, Francis Chu, they don't pay a lot of attention to the business growth, and they're mostly calculating the value of the assets. And on the other opposite end, people like Cassie Wood. And she doesn't care about profitability actually, and doesn't care about the assets, and mainly think about the future growth, the growth potential of the business. And the GARP people, I will say Warren Buffett, he's one of those GARP people. In his earlier years, he was more a cigar butt investor and focus on valuation. But in his later years, he focused on growth at reasonable valuation. That's why his largest holding is Apple stock. And by the way, he made more than $150 billion on Apple stock already, and that's just amazing. That was, I think, his largest gain in his lifetime, 115 billion on one stock. And Charlie Munger, I think, will be toward GARP, and even myself is GARP, growth at a reasonable price. And Tom Russell, I think Bill Nigran, Donald Yachman, Chuck Akre, and Peter Lynch. Although Peter Lynch, we know he's a growth investor, but he does not overpay for growth. So he's actually a GARP investor, growth at a reasonable price. investor, like that. And then I give some examples of companies like Google, Microsoft, ANSYS. Those kind of companies will be is like GARP, I will say. But company like Tesla, Zoom, and NIO, which is a Chinese electric car company, and those kind of stock are considered growth stock. And of course, there are the valuation side. Graham Holdings, it's the company which owns Washington Post before. If you look at the assets actually is probably worth more than the market cap, especially if you slice the company into different parts, it will worth even more probably. But the growth is very minimum. And the outcome of the investing style is different too. For people who focus on valuation and for people who focus on growth. If you focus on valuation, the outcome is probably more predictable. But if you focus on growth, you may get very high returns, outrageous returns, like invested in Tesla. And the return in the last 2 years is just amazing, just dramatic, outrageous. But if you invest in a company like Quantum Steep, last 2 years, you would lose probably more than 80% of your money, although it's also a growth story. If you invest in growth stocks, the outcome is more unpredictable in this area. And I'm more focused on this area. And so basically what GuruFocus style, what I like to do is actually, I rarely focus invest in the scarbat companies, and I don't invest in the company which are not profitable but have high growth potential. I'm more focused on companies with reasonable price and with good growth and high quality. Actually, I do a filter and invest in high quality companies, company with good profitability, very high profitability, and high return on invested capital. Usually they're asset light companies and with reasonable growth and also with reasonable valuation. That's the area I like to invest. And GuruFocus, over the past many years, we developed many model portfolios. Actually, one model portfolio which follows the style I was talking about is the most broadly owned portfolio. Okay, it should most broadly owned portfolio. And the model portfolio was started in 2006 and until 2021. It's 16 years. Over the past 16 years, this model portfolio outperformed the SP 500 13 times. So out of the 16 years, only 3 years, this portfolio underperformed the SP 500. And if you want to learn more about this model portfolio, and let me share the screen with you. It's one of the GuruFocus premium feature. If you come here, it's under tools, model portfolios. And model portfolios, you can see the overall performance. We developed lots of model portfolios, but actually very few of them can outperform market over long term. That's actually very, very strange. Some kind of puzzled me, but that's a reality. We tracked, for instance, if you think like the company's CEO, the CEO buys a stock, the stock should do well. And then we track the performance. The CEO buys performance. And we tracked starting 2012. And this is a green line. If you buy the top 25 stocks that the company CEO buys, you underperform the market dramatically. And unfortunately, that's a reality. If you just follow the CEO buys, the CEO buys, top 25 CEO buys over the past 6 months, then you track the performance, you underperform the market. Same thing with the insider buys. Same thing with CFO buys. You underperform even more. Of course, the stock is not that much. And then you think that, oh, you invest in undervalued predictable companies. That's a strategy screener we have. It's called undervalued predictable companies, different strategies. It's I think it's here, value screens, undervalued predictable. Yes, this one. It's this screen, undervalued predictable. And if you track the performance of that strategy, 25 stock, you do outperform market slightly. You outperform in 1 year, you outperform. Yeah, last year it did really well, but 3 year, 5 year, it didn't do really well. And then how about overvalued? We are value invested, want to invest in undervalued stocks. But then if you invest in overvalued stock, that's kind of strange. And the overvalued stock did better than the undervalued stock over the last 3 year, 5 year, and 10 year period. So valuation, even in long term, to me, actually, from the tracking, didn't really matter that much in last 10 years, at least. But this most broadly owned portfolio, it did really well. And as I mentioned, it outperformed 13 times in last 16 years. And if you look at the 1 year, 3 year, 5 year, and 10 year performance, it outperformed, on average, it outperformed market in every period, 1 year, 3 year, 5 year, and 10 year period. And that's why I'm highlighting this. I'm highlighting this strategy here. And if I recommend you to check this out, check it out, check this model portfolio out. It's a premium feature. We rebalance once a year. We only rebalanced 3 days ago, actually on during the week, during New Year, actually. We only rebalanced a few days ago. And this strategy has been proven to be working, at least in last 16 years. And by the way, the ETF I started is based on this strategy. Okay, and now I come back to the most broadly owned here. And if you have questions, ask me. Yeah, and it's a good question about the entire cycle. Yeah, I think it's a good question. Yandish, I'm not sure how to pronounce your name. But if you look at the history, actually 2006, that was before the market crash of 2008. So from 2006 to today, it is a complete cycle, because we had a market crash in 2008, we had a recession in 2008. And even in 2008, if you look at the number here, when the stock market was down 38.9%, this number does not include dividend. All the numbers do not include dividend here. The S&P 500 was down 38%, and this strategy was doing better by almost 10%, by 9%. Yeah, GuruFocus ETF, I cannot talk about it actually, but you can check it out on GuruFocusETF.com. The website is GuruFocusETF.com. And then, of course, this strategy did underperform in 2007, and it did have more than a full market cycle. Okay, Yeah, 2010, and actually, you're talking about it was this strategy. Actually, 2010, it was this most broadly owned strategy. That's what I was talking about on the website as well. If I come back, yeah, it was most broadly held portfolio strategy. It's the same strategy as I was just showing on the PowerPoint. It was started in 2006. Of course, here only show 10 years, but actually it was started in 2000. Actually, you can see it started December 30th, 2005. That was when we started in tracking the performance. And the turnover, if you hear, the turnover was about 30 to 40% a year. So some stocks, if you look at some stock like Microsoft, which entered the portfolio in 2006, very first time when we started this portfolio, and it's still in the portfolio, and it has gained more than 10 times since then. And then Berkshire Hathaway was added in 2008. Berkshire Hathaway didn't do really well. Apple was added in 2012 at $14 a share, and it gained more than 11 times. We know Warren Buffett cost, I think, is Warren Buffett cost is 120. I'm not sure. There was a split. I'm not sure, but we can always check it out. What is Warren Buffett cost with Apple? Warren Buffett cost. Yeah. Can always check out Warren Buffett cost per share. Cost about 100. Oh no, sorry, cost about 36. That was a split, 36. And in this model portfolio, Apple entered the portfolio in 2012 and has gained 11 times. So the turnover is relatively low. Yeah, let me go back to what I was talking about. Okay, and another strategy actually, okay, this actually was the real money performance. This was the real money performance for 2000 and 2021. And you can see that in 2 years, the SP 500 gained, this is a screenshot from the real money account, 48.46%. This portfolio gained 71.24%. That's a strategy real performance. This purple line is the real performance of the portfolio. This orange line is the SP 500. And yeah, following this high quality strategy, we also developed other model portfolios. This another one I like it actually is I called high quality low CAPEX companies. And we started this portfolio, a model portfolio, only 1 year ago. And you can see this is the SP 500, the blue line. The green line is a portfolio. It gained more than 40%. I think here it doesn't show. It gains more than 36% probably around, and outperforms the SP 500 dramatically. This is a relatively shorter model portfolio, but I actually have a real money portfolio for that. A real money portfolio, and in last 2 years, last 2020 and 2021, I gained 84%, while the SP 500 gains 48%, as it says here. So outperformed the market also dramatically. In last 2 years, this is also a real money portfolio. And so where do you find this high quality, low CAPEX strategy? The reason I developed this strategy was because I wrote that book, Invest Like a Guru. And when I was writing the book, I did lots of study, and the study study convinced me that investing in high quality stock is better than investing in cigar butt companies. And so I developed the strategy which I will share here. I call it high quality companies. Actually, if you look at our screener here, our all-in-one screener, if you come to GuruFocus homepage, and this all-in-one screener, there's one screen called high quality, low CAPEX. Actually, the stocks were generated from this screen. They're generated from this screen. And I put this stocks in this screen into our model portfolio. Then we get the model portfolio, and I put them into as a model portfolio, and I also track it with real money, and it has been doing very well. Actually, last 2 years, as I just showed. It's high quality, low CAPEX portfolio, and I have another one which I created. With limit on return equity, return on invested capital, and that's a portfolio actually we use for model portfolios. The screen, yeah, take a look at this screen, and I think you can get some investing ideas from the screen, I believe, and they're all high quality companies. I personally invest heavily in these companies, and we also build model portfolios. Actually, model portfolios I showed you here, which is the high quality, low CAPEX company US. The model portfolio has just 1 year history. The real money has actually more than 2 years of history. I just showed 2 years, which did really well. By the way, actually, after New Year, it's not doing very well, but it's only 3 days. And before the New Year, it did really well. And the history is short. I want to, please note the history for this strategy, the model portfolio and the real money portfolio is still short. It has not go through a market cycle yet, but we'll keep tracking the portfolio. And as shown here, the portfolio was actually rebalanced also on the New Year's Day this year. This 2001, this was not changed above this one, and you can see from Align Technology here down here is all added in 2022, January 2022, and the turnover is a little about 40%. Turnover, and after New Year, it has not been doing really well. You can see that it went down quite a bit. But it did very well last year. Okay, that is model portfolios. And let me go back to what I was talking about. Yeah, as shown here, the real money portfolio gained 84% in 2 years. As SP500 gained 48%. And I did this back testing, although actually a full market cycle. You're asking about full market cycle. I did full market cycle study, and that convinced me that I want to invest in high quality companies. If I group all the companies by quality this way the quality is higher, goes to the right, quality is higher, here's lower, and also valuation, here high valuation and low valuation. This is a full market cycle, I think 2006 to 2020 or something like that, 20 or 2019. And if you invest in high quality companies like this side, you have a much higher chance of beating the market, outperforming the market. Or if you can invest in very low valuation companies, you also have a higher chance of outperforming the market. So assuming you buy a company, buy a stock and hold it through the market cycle, hold it for 10 years, 20 years, 15 years, through the market cycle, the chance of outperforming is much higher when you buy a high quality companies. The chance of outperforming is also higher if you buy low valuation companies. The worst investment is low quality here, low quality but high valuation. That will give you worse returns. The best will be this corner. In high quality and reasonable valuation will be this this corner. And of course, we know that the market cycle can be very long. And if you think of the cycle, you can probably adjust the investing style some when the valuation is very low. When the valuation is low, for instance, and like the market crash, after crash in 2009, 2010, 2011, like that, those years, the valuation is much lower. And you can disregard the quality and focus on low valuation. Lots of companies with the price is really cheap, you can get great returns that time. When the market valuation is low and you pay attention only on valuations. But when the valuation is high, as it is now, and as it was in 2007, and you want to invest in high quality companies. The high quality companies will outperform the market. High quality but reasonable valuation. You want to invest in those kind of companies. I think this is where we are. This is where we are. And that's where we are. The overall market valuation is high, and we want to invest in high quality companies at this point. Okay, the question. GuruFocus categorize the company as high quality growth. I'm actually developing a ranking. Well, the quality rank is already there, but we're trying to put them all together in one piece. Quality rank and also the growth rank and valuation rank. We're putting all the ranking in one piece. We have one chart which shows where the company is in terms of quality and valuation, growth, dividend, things like that. And of course, we'll also upgrade our all-in-one screener to make it easy to screen for high-quality growth companies at reasonable valuations. That's something actually the ranking I'm working on. The development, of course, will be done by developers. And I see a question in, I'm not sure which language it is, in Spanish or something. I'm sorry, I don't understand Spanish. I'm sorry. Yeah, and if you want to learn more about the quality of companies, I recommend you to read my book, Invest Like a Guru. You can find it on Amazon and on lots of online bookstores. It was also translated into different languages. I translated in, okay, here, this chart. I translated in Chinese, Japanese, Korean, different languages. And I recommend you to read that book. It's an easy book to read. And I hope that it will benefit you. And you will also understand the GuruFocus strategy and how to use the website better. Now I'm back to the website. Again, I talked about model portfolios. I spent lots of time talking about model portfolios because we just rebalanced the model portfolios. We rebalance once a year. That's that's why I mentioned it about. Okay, quality metrics or numbers giving. Yeah, the quality mostly for most of the parameters. For most of the parameters, we have a explanation how it was defined actually for most parameters. The quality is actually the combination of financial strength and profitability. We'll display the quality rank actually, where the ranking is already in the system. We haven't displayed it yet, but you can click on that, click on financial strength, you'll know how it was ranked, how the distribution is, and the profitability rank is also here. You just click on it. We have detailed explanation how it was ranked and the distribution and the calculation. Okay, yeah, for every parameter we're talking about, there will be a page which will explain how it was calculated. Okay. Sorry that you don't understand English. No one here actually can speak Spanish as well, at least not that fluent to do the translation on real time. Okay, now not sure how to help you. We're actually developing GuruFocus website in different languages, where we work on Chinese, on Korean, Japanese, and we're also considering other European languages like Spanish, German. We're also considering that. Okay, now I want to talk a little bit more about the website feature here. And if you come to our homepage, we're actually, if you see this button, try our new dashboard. We are developing a dashboard for users. You've come to the site, become the member, and you have your own dashboard, which you can customize. You can customize to remove the contents and add contents. Of course, we'll create more and more widgets for this website, for this page. And you have more option to create your own dashboard, so it'd be much easier for you to use. And if you have feedbacks, always click here to give us a feedback. We'll consider your feedback. And this dashboard, of course, here like Guru stock picks. And here are the articles and the different calendars, earning calendar, dividend calendar, split calendar, and also we have historical interview with gurus, the guru comments. And one area, for instance, you can see the market performance by sector, by on different dates. You can see which sector did really the best. Or the 1 year past 1 year, you can see SP 500 was here about 28%, and the energy returned 63% in the last 12 months. That was the highest return, and communication service had a worse return. Technology actually was not as good as energy on average, and also you can see the daily distribution of the returns. Here, I think you can click and go to our website to check what's the daily performance, today's change of how the market is doing. If you can see that, okay, let's take a look at the SP 500, the stocks. How many went up? It tells you how many went up, how many went down, and so you have an idea what NASDAQ stocks. NASDAQ has not been doing really well today. SP 500 did relatively better. Actually, more stock went up or down than down. That was a little bit surprising for me. And then you can look at the Dow stocks here. You can import your own portfolio. You can check out your own portfolio. Just click here, import the portfolio, and it gives you statistics of, for instance, I import one of my portfolios here. I give you statistics, how many went down, how many went up, and also you can look at the in bubble chart, how the distribution of the returns are. You can look at into a map also. So that's a feature. It's under the all-in-one screener. If I altogether, if I come to the all-in-one screener and I click on aggregate, and it will give you the overview of the chart. That's where we are. Okay, that's kind of strange. I will check that. Yeah, that's an important feature actually. You can display the SP 500 company in map to see how they're doing. And can also see it in bubble chart. The big companies today, most technology big companies are down also today, and in aggregate. Yeah, and that's an important feature. Okay, let me look at the questions. Yeah, feel free to ask me questions about the website, especially I was talking about the dashboard. Encourage you to try out our dashboard, and we want to make it useful to you. We want to make it helpful and help you to generate higher returns as much as possible for you. Yeah, please try it and give us feedback. We can do a better job serving you. Okay, let me look at the question. Percentage shares by insiders of non-American company can be given. A present company's US insider. Yeah, so this question is about insider data of non-US companies. We do have some of them. We do have insider data for some of the non-US companies like Chinese, and we're working on Korean and Japanese. For those we will get them. But for lots of other countries, it's hard to get. We're gradually getting more countries, but we're not getting all of them. On the top, okay, the top three goals. What were the top three goals of the investing world that are most constant? I personally like Chuck Akre very much. Chuck Akre, to me, he's a high quality growth type of investor, and he is my top guru. Let's look at his portfolio. Actually, Chuck Akre. Yeah, just search his name here, and you'll find his current portfolio here. And let's take a look at his top holdings. His top holding is MasterCard. Yeah, Moody's. MasterCard is first we know a credit card company, and he owns it. He owned it for a long time. If you click on the icon here, yeah, he bought it. Here you can see he started to buy back in 2010, and has having it for more than 10 years. His cost is really low with MasterCard, I think. Of course, over the years, he added to a position, but the initial earlier years, he was buying at a very low price, like $20, $17, and $8. He was buying it at $20. And today, where it's traded at much higher at 400, 300 something. So he has made great returns on the stock. And Moody's is the same. Moody's, he has bought in 2012 at much lower price, at 37, and today it's also more than 10 times of gains. He's a top guru. Actually, I personally extremely respect, And he actually, by the way, he was one of our he was a keynote speaker of one of the GuruFocus conference I hosted, I think in 2017 or 2018, I forgot which year. I look at his company, American Tower and Visa, and really, so he liked to invest in high quality companies, and his investing style is, I will see, I'm trying to learn from him. And I love one of his quotes. He said he talked about this is from one of our, in the conference. He said experience is from, oh, I'm sorry, I can't forget. Knowledge is from experience from mistakes, something like that. I'm sorry, I forgot. And that, yeah, he's one of the gurus I respect. Of course, Warren Buffett, but I think I still, between Warren Buffett and Charles Akre, I like Charles Akre better. And Donald Yackerman, he's one of the gurus I loved, but he retired. He retired. His son Yackerman, I think, is now managing the company, managing the portfolio. Yeah, feel free to ask me questions. We still have a little bit more time. And okay, let me look at another question. Do you know what are the applicable parameters for evaluating different industries? For that question, I would recommend you to read my book, Invest Like a Guru, the last chapter of the last chapter of my book. I was discussing which parameter to use for which industry, and I recommend you to read it. It's available on Amazon, and I think it has, let me show you here. It has a very good ranking also. Yeah, Invest Like Guru book. Yeah, that's a book I wrote on Amazon. It was very, pretty high ranked, I would say, 4.5 out of 5, 180 global ratings. Yeah, recommend you to read my book. For the last chapter, it talks about the valuation. Okay, well, Charlie Munger bought Alibaba. It was, I think it was Charlie Munger did buy Alibaba. Yeah, we can always check his portfolio here. Charlie Munger. We can look at his current portfolio. And he actually added, we reported about it, he just added Alibaba recently, actually, a few days ago at a much lower price. And Alibaba, he added, if you look at the weighting now, the weighting, okay, his largest weighting is still Bank of America, and then Wells Fargo Bank, and Alibaba. He insert in last quarter, actually, in last quarter, he doubled his position with Alibaba. And of course, he's losing money on it. If I click on here, yeah, I'm sorry, he added during the third quarter of last year. The fourth quarter portfolio is not out yet. And but there was a real-time report, actually, I think, or he bought Alibaba. There was I remember seeing the report yesterday. He bought Alibaba, he added Alibaba. Yeah, that's Charlie Munger. I will, if it's not here, I would ask our people afterwards. Yeah, that was reported in the news. He bought more Alibaba. Okay, any other questions? I will be glad to hear your questions, and I recommend you to try our new dashboard. And there are a few other things we're working on. For instance, we're redesigning the stock pages. We're redesigning the menu here to make it more user-friendly, to make it look better, look and feel better. We're working on that. And also encourage you to check out our all-in-one screener. And there are so many things you can do with all-in-one screener. You can, for instance, you can create your own customized filters. Lots of people don't know about this. You can create your own customized filters on our all-in-one screener, and enter your own formula and to create your own all-in-one screener, own filters. You can also use historical numbers to do screen. And if you just click on this little plus signs next to the filter here, you will be able to use the historical numbers. For instance, here you choose market cap from 2019 to current year grew by 5%. That's just example. And the formula expression will be generated here, and the screen will work for you and to find the stocks for you. Yeah. Okay, Bling, very good question. Do you think high quality and low caps will do well in inflationary times? I think so, actually. Especially asset-light companies, low caps companies do well in inflationary times. Actually, Warren Buffett talked about this before. And when you have low CAPEX, you don't need lots of investments, but you are much more scalable. And usually you also have this pricing power. And this type of company do well during inflationary times. And that's what I believe. Of course, changing investing style, switching invest style between different styles, it's impossible. Timing it right is impossible. That's why I would rather to stick with one style and for a long time. I think it will work better than you trying to follow the market and trying to switch styles over time. I think it's an impossible job. And okay, if there's no more questions, that's about what I want to talk today. Again, our next meeting will be on this Wednesday, first Wednesday of every month, first Wednesday of February, and I will see you. Okay, there's a question, okay, about the book. I think I didn't read the Kindle version, but I don't think there's difference. There should have no difference between the Kindle version and the hard copy. If there's no more questions, I want to thank you for coming, and I will see you again in February. Thank you all, and wish you a great year in investing in 2022. And see you next month.